Hello, I'm Dr. Stock, and in this video, I want to talk to you about the FHFA loan level price adjustment that takes effect on May the 1st, where the high credit borrowers that have the 20% down for their mortgage ready to go are actually going to be penalized for taking out that mortgage and having that high credit. And that penalty, as we'll call it, is then used to subsidize the low credit borrowers to make it cheaper and more affordable for them to buy the housing. Now, I don't actually want to talk to the high credit borrowers in this. Instead, I want to talk to the low credit borrowers in this and the people who don't have that 20% to put down. I want to advocate for you because this is not good for you. This is not something that you want to take advantage of, and I have a lot of reasons why. I would like to do so through analogy. I am a math teacher by trade, and I want to talk about elementary math, single-digit operation. So adding with single-digit numbers like 2 plus 3, subtracting 7 minus 5, multiplication, division, those early math facts. So let's say that you had kids who were good at those in class, didn't really need much help. They always seemed to get it. Those are like the high credit borrowers that we have. Now, the kids who needed extra support, needed extra help, and just to be clear, I am not talking about students that would have a disability in mathematics. That's different. I'm talking about just the typical student who might need a little bit of extra help with their math facts. Now imagine that student who just doesn't quite take to it as quickly as the others. Imagine just jamming a calculator in their hand back in kindergarten, first grade, and instead of them ever learning the math facts, just learning how to press buttons and not knowing exactly where the answers came from, just writing the answers down. That does help that child to be faster at first. It helps them up front. However, as time goes on, they're going to fall further and further behind their classmates who have gone through the pains of building up their skill over time and then using that to generalize into later skills. Now, how does that go along with what we're talking about with credit? People who have put in that work to have that high credit, that have shown that responsibility, that have practiced paying their bills on time, people who have worked to have that nest egg of 20% in order to put down on that house to avoid paying PMI, people who are making those right financial decisions, who are educating themselves, they did a lot of work to get there. And I'm not saying that you, if you are a low credit borrower, that you didn't do that work, that you're not trying hard. What I'm saying is if you're able to get a loan on a house that you can't afford, right now you're still learning about managing your debt, or you're having financial trouble, and there's reasons for that low credit score, or there's reasons that you don't have that 20% down. Regardless of what those reasons are, this practice, this adjustment is making it easier for people to take on $200,000-$300,000 worth of debt when they're still working on managing what they have. And that's just the mortgage. If you're buying a home, if you are a homeowner, you still have to buy appliances, you have to buy furniture, and just the myriad of other things that take place within that home. And it gets expensive. So do you really need to move into that house? Can you rent a little bit longer? Are there ways that you can work to increase your income? How can you increase your credit score? Not only will increasing the credit score allow you to do the responsible thing and pay cheaper rates overall, even with the penalty, you'll pay cheaper rates if you're able to get that higher credit score. Also, by having that 20% down, you're not paying something called PMI, private mortgage insurance, where you are actually charged to insure the people who are giving you the mortgage. You are insuring the bank that you're not going to default on that mortgage. And if you do, well, you paid their insurance, they're going to be covered. You're going to be the one who suffers in this. It's irresponsible. This is like giving the child the calculator early on. They never develop the early skills, so the later skills, they just give up and they are done. And that's something that I would absolutely not like to see happen to anybody. So working on educating yourself, building up your financial prowess, building up your financial foundation, increasing your income, increasing your credit score. Don't take the shortcut. It is just bait. It is something to sound pretty. It is something to sound nice. And honestly, why were they able to do it? Because it's really no net change to the people making the decision. Because what the net change is, taking the money from people who have the income and just moving it over to people who maybe are lacking that income, or at the very least lacking the credit score, the financial responsibility, the evidence that we can collect on that, and also taking that money. And if you don't have the 20% down, still making it cheaper to get in that home in the first place. But once you're in, you're stuck. Like, you are in that mortgage. And if your financial situation is not a strong thing, and if it's something that you're having difficulty improving, Is that mortgage really the best thing at the time? Is it really the time that you want to be buying that home? Those are questions that are worth exploring, and you might have to set some pretty strong feelings aside, because I know that there's dreams about that really wonderful, nice home, and to have your friends and family over and to look around and to see what you have around you. But I can tell you that it's not worth the financial stress. And if you are paying on that home, what other things are slipping by the wayside? And for me, PMI is just one thing. The whole reason that I worked so hard early on in my life to buy a home and avoid paying that PMI, to get that 20%, I should say, the 20% down payment, was I did not want to give my money away. And that's exactly what you're doing if you don't have that 20% down, is you're paying that private mortgage insurance anyway. So you're getting a more expensive mortgage because you have a higher rate, because you have a lower credit score. So your mortgage payment is going to be higher anyway. And you're also paying for somebody else to be covered. You're not even paying, you have to pay your own homeowner's insurance, but then you also pay the banks to be insured as well. To me, it's absolute lunacy. I don't know why you would take that offer if you didn't have to. There's not necessarily that same rush, and it doesn't necessarily take that long to build your credit score up from where it's at. There were things called bonded credit cards. They might still exist. There's other plans where you make the deposit, you have the cash available, and then you use that card and you can build your credit, and it's bonded to you. It's bonded to that amount. It's covered by the money that you already have put in. So even if you have the lowest of credit, you still want to work on digging yourself out of that hole, and you want to look for ways that you can increase your earning potential and really capitalize on those moments. Those are the things that are really going to help you and really move you forward and make things more affordable, not this ruse that's in disguise. I don't want to see people get caught up and hurt in this. I know, going back to that kid thing with the calculator, it is difficult to watch them struggle, to get frustrated, but they can do it. You bring things down to a level where they can handle, and they will dig in, they will push forward. And so for you, that's the same thing here with the financial situation, is that you need to adjust to a level that you're currently at, and then really start digging your heels in, grit your teeth, and start moving forward. What is it going to take to move that credit score up? Because that's really what's going to make things affordable for you. Not only is the mortgage getting cheaper, but you're also earning more money. And so that's also helping. You're being more responsible. You're increasing the likelihood that you're not going to stay in debt, that you're not going to get behind. And by having that 20% down and paying that, that is something that avoids the PMI. So I'm sure there's a lot of nuance in that. Some people can come in with other ideas about tax and assets and all that kind of stuff. But the very simple idea here is it makes much more sense to put yourself in position to have good credit first, and to actually have some money to put towards that down payment, so that you're not throwing money away on something like PMI. That's my take on it. I wanted to share it with you guys. I got my doctorate in education because I'm very, very passionate about helping others, and however I can do that. And here with this FHFA loan level price adjustment thing, the people at the top, the people with good credit scores, I should say, people with good credit scores, people that 20% down, they'll find a way to be fine. You should do the same for yourself, is to find a way to be fine. Don't fall for this false bait that's out here right now. I guess it's real bait, but it's not the helpful thing that you would think it is. That's what I have for you in this video. If you guys enjoyed my commentary, please consider hitting the like button, subscribe button, and ring that notification bell to see any time that my videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.